Hi there traders, and welcome back to Elite Trade Skills and our final installment of our price action video series, which is part 5 on multi-time frame analysis. So we hope you enjoyed the series, so stick around and we'll see you on the flip side. In this video, we're going to talk about multi-time frame analysis. So I had a question during the week about entries and how we enter and why don't we let the candle finish before we enter and so on. It brought up the idea of multi-time frame analysis and how that could really benefit a lot of people to improve their trading or enhance their trading. All right, so what I'm going to walk through with you now, just a couple of examples. You can see on the chart there, we've got the Wall Street 30. There's an initial example here off these highs, looking for a short sell there. And we've got an example I'm going to discuss another short sell and how using multi-time frame analysis would benefit both of those trades. All right, so we're looking at a 30-minute time frame to start with here. So what we might have done is have different analysis and we're looking for a particular reason. We're getting short here. Now, the first one that pops to mind is a break of those lows. All right, so on our 30-minute time frame, we're looking at a break of those lows. You might wait for that candle to finish. Now, if you're waiting for that candle to finish, your entry would be just below the finish at the low of that candle. Okay, you could have two areas to place your stop. You might have a stop placed well above, which is quite wide risk. Now, if you took a break of that low and you took it during this candle, your stop has to be above here. Okay, that's pretty much the only area I see to place your stop. Now, if you look at that, if it was that break at say 80 and your stop is somewhere above 110, that's a 130 point stop on that one trade. Now, I don't know about you, I wouldn't be wanting to take a 130 point hit if I got it wrong. And there's the potential on that candle there. You can see if the market's pressing down, you get stopped into a trade. Who's to say it's not going to come and reverse all the way back up? That's just a washout of that level, and it turns around, continues on higher, and that's a key higher low, and we take out your stop at 130 points down. All right, so I would be looking at that a little bit differently. I would look at using a 5-minute time frame, for example, for my entries. So I would mark up everything on a 30-minute time frame, and I would look at my key levels, my key areas I want to trade in. But for my entry, I'd be looking off a 5-minute time frame. Now, doing that, I see giving two major benefits. All right, you get reduced risk on any one trade, and you can also maximize your gains. So I see that as two key areas in your trading, which helps you improve your statistics longer term. All right, so what I'll look at here, we've got, look, we'll take the two scenarios, the break of that low or the break of that candle low. Now, who's to say, again, if you're taking a break of that low, you've got the market's reversed, it's come down, you've got a break of that low, we don't know that's just going to reverse. So again, I don't see any lower high in that. I mean, if you take, as that candle's coming down, you take an entry, the break of this first candle, we don't know if that's going to break, wash it out and flush straight back up. So again, where do you put your stop loss? Is it just above that high because the candle hasn't finished within that half an hour, or do you put it back up here? Now, if you put it back up here, to me, that's crazy because the risk has gone from 130 to say plus 170 or 80. Now, if you're taking a risk of 150 or more or thereabouts, you've got to make sure you've got a solid swing trade and you're looking at 300 points plus or 400 points plus on that trade, 2 or 3 to 1. All right, so again, I would be dropping that down and using a 5-minute time frame, which we'll discuss in just a minute. So the second scenario I want to look at is a continuation trade off this 30 minutes. So we've marked up much of the same as what we saw previously. Market's pressed down, we've got that expansion down, we've got that reaction back up, held a inside level, high low, come back up, failed off that level and started to proceed and expand back down again, took out these lows, which you can see, this low, took that out and continued lower before we had some buying start to step in and bounce up. So at this stage, forgetting about what happened later on, at this stage, if we were looking for that, again, retest fail, like we saw in here, we're looking for a retest fail. Once the market presses down, we're looking for the same scenario as prior. The market's pressed down, popped back up, retested that level, that high, and we're looking for continuation. Now, you've got two ways you may look to enter short on that trade, just from the 30-minute, not looking at multiple time frames at all. Okay, you might look at a nice aggressive trade. You're taking a break of that rejection candle you can see here. It's popped up, rejected, closed basically on its lows, and you're looking for a short, a few points below the low of that candle, or something less aggressive. Might be that second candle. As soon as you break the low of that second candle, which is this second green candle, this initial green candle, you've got expansion, rejection, break of that low, you're going to get short. And you're looking for expectation there's something that's going to drive lower through these lows, and you've got a nice short on your hands. So they're the two potentially entry areas, but either way, I mean, on this first aggressive entry, you've got your stop well above that that resistance zone, or the RTF retest fail zone, somewhere around 25, say 660, sorry. And on the second candle, you might have your stop just above this one, or you might have in the same area. But either way, you can see the risk is it's either quite wide or getting wider. So if we now go and look at, we'll go and look at the first scenario on the 5-minute time frame, and I've got a snapshot of that just to remind us what's happening. We'll just go down to the 5-minute chart, and we'll start off with the first scenario. Oh, it's not there. There we go, on the 5-minute time frame. So by using, the first scenario, we're taking a break of this low, okay, that initial low, and the second scenario, we're taking a break of that initial candle. Once it broke through the low, it's rejected, and we're looking for that break of that candle for our short entry. Okay, so if we go back to here, pretty much the second scenario, a break of that low was equivalent on the 5-minute time frame. You can see it's pressed down, it's bounced back up. On the 5-minute, we can see a clear-cut weakness coming into the market and a clear-cut lower high coming into play. So if you're going to have your risk all the way back up here, plus 130, you can halve that at least. You might have a 50-point stop loss on that trade by having a entry on the break of that low, and you can have your stop placed just above that 5-minute lower time frame. So already you can see by using a different time frame, you've halved, or at least halved, your risk on that one trade. Now, if you had a break of that low, there, your risk well above at 130. Again, on the 5-minute, I would be more than likely, I need to see some price action on the 5-minute to confirm that weakness coming into play. Because like we said, if that broke through there, you got stopped in and your risk is well above there, it could be a flush, a wash out of that support zone, and it turns around and bounces straight back up again to stop you out at minus 130. We don't want that. We'd rather see on the 5-minute time frame a clearer cut entry and clearer cut weakness come into play, which you saw. So the second thing that we were talking about is maximizing your gains. All right, so you can see, we'll just go back to that 30-minute. On the 30-minute, it was basically 1, 2, 3 candles down, or maybe that fourth candle down. So if you had your entry was on the first or second one, where are you going to place your risk on that trade? You've got no real lower high come to play. So it's more than likely going to be the top of the candle. Well, it probably should be the top of the candle. Otherwise, you're in no man's land, really, without any evidence that you've got some strength coming back into it. There's weakness come into play. But trading off the 30-minute chart alone, there's no real evidence that you should be lowering your stop loss. It's probably going to be right up here, basically where you got into that first entry, or the second entry, sorry. And then you might, on the first entry here, the break of that low, you've probably been up a few points. But considering if this just comes down and bounces all the way back up, that's quite a hefty risk to take. All right, so using the 5-minute time frame, the different multi-time frame, you can easily lower your risk. So if we say that's our initial risk, as it comes down and breaks this low here, you can lower your secondary risk basically to where you got in, and you've locked in a small gain on the first entry. Then you could probably lower it again. You can see it's expanded lower. You've got a nice green candle, got rejected again, started to break the lows into new lows. Once we've got this bounce here and we've got a break of that low, you've again lowered your risk. So you can see by using a lower time frame to manage your trade, you're really lowering your risk on the trade itself, and you're maximizing your gains. All right, so potentially, I mean, if you got, by the time you got to here, it's pressed back down in those lows and started to recover, you might have really lowered it a little bit more. Or that could be the trigger. Once you get this sort of thing, break at that level, that's the trigger to get out of the whole trade, lock away your gains and call it a day on that trade. All right, so that example there gives us the two scenarios of maximizing your risk, minimizing your risk and maximizing your gains. Now, if we go back to this second example, we're looking at trading short off this RTF, this failure. All right, so these are the two levels. This is your aggressive entry that we had off the 30-minute chart, and this is your less aggressive entry, which is basically just a break of that low there on the 5-minute time frame. Now, on that aggressive entry there, for me, that's perfectly fine. On the 5-minute time frame, it looks really, really good. Okay, so you've got this bounce up here, this move back off that high, it's come back up, retested, it's even flushed out that level by a few points, and then on the 5-minute time frame, we've got a lower high coming to play, even a secondary lower high. So what you can see, I mean, if you're being very aggressive, you can enter on that little lower high there, but probably this second one, once you've got a couple of green candles come into play and you've got an expansionary red candle straight through that low, that entry there is quite good. But the difference is on your 30-minute, we go back here, your 30-minute entry there, your stop's way above. All right, so if we just look back, which is way above this high, the retest fail level. So if you're looking at that, we'll just say that's a stop. The difference, you've probably halved your risk on that trade, on the same entry, using the same entry, by using a multi-time frame analysis or a multi-time frame approach. All right, but what it's also done, you can see that as it expanded lower, you're able to lower your risk, one, maybe down to here somewhere. As that's expanded lower, you've got this expansion candle there, and you can see it's just come into that low. Okay, you can expect to bounce off a low like that. You've bounced off, you've got a green candle, then you've got a couple of red candles trying to go lower again, and you can see that it just did not want to move. It did not want to go lower. So looking at that chart, in my head I would have been thinking, okay, if I'm not going to go down, which we should do, especially remembering the 30-minute chart, that's a couple of red candles, we should continue down like we did in the previous example. Like we did here, we should have just continued straight down again. But instead, we started to bounce, and we've got a higher low coming into play on the 5-minute chart. So that's probably a key area. If you want to tighten up your risk, you can tighten it up. You can lock in a small gain on that aggressive entry. Now, if it was a second entry on the 30-minute chart, you're pretty much just going to break even. And if you're trading off that one time frame here, off the 30-minute, either one of those, your stop is probably still above that retest fail level, and you can see what's happened prior. You've got it fail off here, you've got another retest fail below, and it's turned around and popped straight back up in that 1 30-minute candle, comes straight back up and stopped you out. So you can see how using a multi-time frame analysis can actually just improve. You can improve your strike rate. That was a couple of trades there, either aggressive entry or non-aggressive. You've turned into a profit or a break-even trade just by using a different time frame approach off the 5-minute chart. And this second trade, you could have this first trade, you can see by using that 5-minute time frame, you've really locked away some healthy gains on that. All right, so I think this is it's a really good approach that many people, if you can understand how it works and why it's working and how it can improve your trades, it's a great approach to improve your overall statistics on your trade, your overall hit rate, your overall win-loss rate, and your gains as well. Going from, like I said, if you're halving your risk from a 30-minute by moving down to the 5-minute, you're also getting your strike rate of 2 to 1 or 3 to 1. That's increasing quite a bit, okay? So I hope you enjoyed that, traders, and watch out for the next videos. Well, we hope you enjoyed that, traders, and thanks very much for listening. Remember, if you did like our video, please subscribe to our YouTube channel for more great content and sign up to the website to get access to all our premium videos for free. Speak to you again soon.